The introduction of a 1.7 million paragraph piece of legislation brings in a new reality for banks and financial firms in the European Union and around the world. Its implementation was already delayed by 1 year, but still, only 11 of the EU's 28 countries have put it into national law.
Unfortunately, still not all member states had transposed MIFID II. And this then can lead certain difficulties with trading of the shares of those countries which had not transposed MIFID II. So we had been highlighting this issue with the finance ministers in ECOFIN already for quite some time.
The MIFID II regulation is an update on the original Markets in Financial Instruments Directive after the 2008 financial crisis. It includes forcing trading platforms to be transparent about their prices so that investors can shop around. Fund managers won't be able to pay banks and brokers in lump sums for things like research and trades to allow clients to see clearly how their money is being used. The European Securities and Markets Authority will have far more power to put an end to financial products it deems to be harmful. The rules will also limit the amount of power a stockbroker can have over a single commodity. The banking authorities in the UK and Germany decided to give an initial exemption to 3 clearinghouses, where trades are held before they're completed. Some in Europe think MIFID II is just further over-regulation.
Heavy regulation is good for the big and bad for the small, so it's bad for competition is what happened with MIFID I. The heavy burden of regulation did have an effect of rewarding the bigger players in the market that were more able to deal with all the bureaucracy.
Stock markets across Europe took the implementation in their strides during initial trading, but it's likely to take some time before the long-term effects of the legislation play out fully. Jack Parrock, TRT World, Brussels.
And David Madden joins us now from London. He's a market analyst at CMC Markets. David, great to have you on the show. Happy New Year. Tell us a little bit about how the markets reacted to MIFID II today.
Happy New Year to you too. In relation to MIFID, to be honest, it was actually quite muted, the reaction. Whether it was big banks, pension fund managers, or smaller financial services companies, it was quite a mixed bag. Some finished higher in the day, some finished lower in the day, but the common theme was low volatility across financial stocks today. I'm assuming because this has been well in the pipeline and the financial markets have been well aware of this for some time now, it really was a muted reaction here in London today.
What's your feeling about MIFID II, David? Is it going to be greater transparency for investors, or is it going to be onerous regulation?
I would say it would be the former. It's more likely to have greater transparency, and given what we've come out of the financial crisis of 2008, 2009, I think that's what a lot of particularly retail investors would like to see. MIFID II is going to have a much more accountability, stage by stage in the investment process. Each individual or professional will have to clearly mark out the reasons why they did such a transaction or such a move. On the flip side of that, that's going to come with more cost, and the additional regulation is going to come with a higher cost. And I suspect the majority of ordinary pension holders out there would rather accept that trade-off of additional costs in exchange for additional protection and transparency.
David, what do you say about this other criticism about MIFID II, that it actually benefits the bigger players in the financial industry because, as you mentioned there, that there are significant costs involved?
Unfortunately, it does favour those with the larger organisations which have better economies of scale. This additional regulation, sure, it provides transparency and protection, but it also comes with a much longer and more detailed paper trail. And larger organisations will be far better equipped in terms of economy scale to deal with that than the smaller houses.
Do you think it's going to succeed then in its goal of eliminating these conflicts of interest between the research side and the people that sell that research and sell the financial products that go with them, which was criticised in a big way for being one of the causes for the financial crash of 2007?
It will certainly take a large dent out of it. The so-called unbundling of these packages, whereby trades and research are packaged together, and when a fund manager is placing them together, they're not entirely sure, or the end customer isn't entirely clear what exactly each aspect is paid for. I do feel it's going to largely have the unbundling effect. Will clear it, but it still probably will be there nonetheless.
David Madden, CMC Markets. I'm afraid we're out of time. Thank you so much.